Well, the Nasdaq closed exactly flat here today, so you probably assumed we didn't have a lot of price movement. But if you inspect an intraday chart a little closer, you'll see that we actually saw some moves up and some moves down throughout the day before finishing about break even, based off of various news reports, including Amazon reporting what its second city is going to be regarding its headquarters, or cities, plural, I should say. We also found out that President Trump and President Xi officially will put trade talks on their docket when they meet a little bit later this month. And then we saw some negative news from Boeing regarding some airline parts that potentially could have caused an accident here recently. And of course, Boeing is the most important component of the Dow Jones Industrials because it is a price-weighted index. And so we saw the Dow become a laggard here in today's session. What I thought we would do is take a look at a bear call spread on an index here today, now that we have some bearish postures popping up. So let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee, and it's November 13th, 2018. First of all, for those of you that are new, welcome. We're grateful to have you in our audience here today. Remember, you can go to YouTube and subscribe to our channel there. And while you're there, make sure you check out our description area as well and sign up for our email distribution list, which will also entitle you to receiving what stocks are giving you overbought and oversold cluster signals in the S&P 500. In addition to that, we also are heavy users of Twitter. Feel free to follow me. My handle is @BrandonVanZ. If you ever see these tweets regarding the Market Outlook videos, we'd certainly appreciate a like and a retweet if you get value out of these videos on a regular basis. We also have a presence on Facebook. We'd love to see you over there as well. You can check out our group in the web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into today's analysis. So as you can see here, I've got chart 4B pulled up in front of us. For those of you that are Market Scholars Premium subscribers, you can follow along with me at home with your charting package as well. So this particular chart package, or this grid, I should say, this 4 grid, is basically just showing us 3-month charts of the 4 major U.S. indices. We've got our S&P 500 in the upper left, we've got our Dow Jones in the upper right, we've got our Nasdaq in the lower left, and our Russell 2000 in the lower right. Now, the way that these things are coded with the computer programming code called ThinkScript that goes into them, we've got it designed so that the background colors of the charts will turn different colors based on the posture of each of those particular indices, based off of the market forecast intermediate term line. So as an example here, notice that the S&P 500, after today's slight pullback, again, this was a pretty small move, only down 0.15%, but it was enough of a pullback to give us a bearish posture again. You'll notice yesterday we had a weekly bearish posture. Today, it would be considered a strong bearish posture, and we know that because that color shaded of pink is darker now than it was just yesterday. So, and that occurs, by the way, when we get the green line to trend lower and below 50. So as you can see right here in our label, the intermediate line, or the green line, is at 49.50 and falling. So in other words, it was falling yesterday as well, but it was still above 50. Now, with today's pullback, that line is below 50, and so our posture has moved back to strongly bearish for the time being. And you can see that's the same predicament we find ourselves in with the Nasdaq as it stands right now, and also the Russell 2000. However, the Dow Jones, as you can see up here in the upper right, had been one of the leading areas of the market. This has been a market that has preferred kind of the mega cap mentality as opposed to the smaller cap names out there as a place to hide out. But with today's news regarding Boeing, as I mentioned, it was actually the worst performer on the day of these 4. We were down 0.4% today, but you'll notice the light pink background color there signifies that we don't have a strongly bearish posture yet. Notice that the intermediate term line is falling, so it is a bearish posture, but it's only a weekly bearish posture because that line remains above 50. So that's kind of where we stand across the board. Again, it was mostly a flat day, flat to down, but our postures across the board from an intermediate perspective remain bearish. Let's take a peek at another chart here. Let's go to chart 4C now, and this will be our 3 green arrows setup. Again, we're looking at the same 4 major U.S. equity indices here from a 3-month perspective. In this particular case, we're looking at a 3 green arrow chart setup. And when we see a green background colored chart, like we did for the Dow here a few days ago, that means that we have 3 green arrows. A green arrow where price is above a moving average, a green arrow where MACD is above the 0 line, and a green arrow on the stochastics because it's rising or in that upper reversal zone. But as it stands right now, notice that as we look at all 4 of our indices, we have white background colors. And so what that means is we do not have 3 green arrows. We have a mix of green and red arrows. And as you can see, the culprit in most of these cases here is the moving average line itself. You can see a red arrow crept in there, there, and there. And those appear when price goes back down below the moving average. So we had a brief period there on all 4 indices where price went above the moving average, but it just couldn't hold the line and has kind of given up the ghost here in the last few days before this market decides what it wants to do. So we kind of find ourselves in a little bit more of a middling ground right now where we don't have a strong trend one way or another. We don't have the strong bearish trend that we saw most of October, and we don't have the strong bullish trend that we saw earlier this year. We kind of have a middle of the road type of a market that's trying to figure things out. Remember, from a seasonality perspective, supposedly this should be a good time of year for the bulls. On the other hand, we did just have a pretty furious rally off of the bottom, and most of the time we don't just get V-shaped bottoms. A lot more often we'll get W-shaped bottoms, and perhaps that's what we're setting up for now, more of a double bottom type of behavior as opposed to just a straight V bottom. Let's take a peek at another chart here. This time let's go on over here to chart 4D, and this will be our 1040 crossover method chart. And you will notice that we have a bearish crossover to report down below here on the Russell 2000. So that is, that's a first sign of bearishness from a longer term perspective on these 4 charts here. The other charts, we do not have that crossover yet. And maybe I should back it up a second just in case you are a new viewer of these videos. What we're looking at on these charts, let's use the Dow Jones up here as an example. We've got this orange moving average line right here, and that represents the 10-period exponential moving average. Now, in this case, we're looking at a 3-year weekly candle chart. So in other words, this is a 10-week moving average that we're looking at right here. That would be somewhat equivalent to a 40-day moving average for those of you that are looking at 5 trading days throughout the week. This blue line right here represents the 40-week moving average. And that would be equivalent to the 200-day moving average for those of you that kind of want to do that conversion. Some of you might have heard of this referred to as a death cross and golden cross before. In other words, when the more sensitive line, in this case the orange line, crosses up and through the less sensitive line, in this case the blue line, like it did back here, way back in March of 2016, that would be known as a golden cross and a bullish crossover that we expect, positive momentum going forward. Obviously, the opposite can also be true. So when the orange line comes down and crosses below the blue line, we start to get a little bit more nervous that the juiciest part of the bone has already been eaten. We don't have a lot of meat left on that bone from a trending perspective. That's kind of the mentality. Now, obviously, no technical indicator is perfect, so there's been plenty of times where you just see whipsaw when it comes to that. But you can see just clearly here over the last few years, had you kind of obeyed the crossover method from a longer term perspective, you would have had really outstanding results because you would have remained bullish for the vast majority of the last 3 years. But it is true. We're starting to see a little bit more wear and tear. The next one that has the possibility of giving up the ghost is likely going to be the NASDAQ. Notice that the orange line is very close to that blue line as it stands right now. And remember that this MACD 2 lines that we have set up down below will help us identify that if it's too hard to see with the naked eye up here. Because basically when this black line comes down and crosses below this pink 0 line, it basically means that this orange line is crossed down below the blue line. So it's just a little bit easier to see it down here. So you can see we're getting awfully close. Let me right click on that and go to maximize sell. and you should be able to see it in greater detail right here. Again, this is the NASDAQ, so this is the more tech-heavy, growth-oriented index, and you can see that we're getting very, very close to having a crossover there. So if we continue to have bearishness from tech stocks, and of course, we've seen some problematic areas, including Apple, which had been a stalwart for so long. Apple's really struggled here recently. I know one of the trade ideas that I did on this video here a few weeks ago was on, it was a bearish trade on Skyworks Solution, a key Apple supplier, and they have really struggled here recently, along with a lot of other technology names that are out there. So, the NASDAQ remains a little bit of a problem child here because it is a little bit more focused on the growth areas of the world. In fact, Tilray is out with their earnings announcement after hours. Tilray is a stock that would be on the NASDAQ. As you can see right here, it wouldn't necessarily be in the NASDAQ 100, but it would be on the NASDAQ exchange. And Tilray, for those of you that are not familiar with that name, is associated with marijuana. And of course, with more and more states legalizing marijuana for various purposes, recreational or medical, these types of companies have become a little bit more interesting to investors and traders this year, to put it lightly. Some of them have done fantastically well, but they can also come with a little bit of heartburn. As you can see in particular with Tilray, it touched a high this year of $300. It is now all the way back down to $111. Now, of course, if you bought at $300, you are in the house of pain at $111. On the other hand, the 52-week low for Tilray is $20. So had you bought at $20 and you're still holding at $111, that might make it a little bit more digestible. The point being, these are some of the wildest stocks in the market right now, and they can sometimes give us a sense of what type of risk appetite the market in general is seeking out. And the reason I'm talking about them right now, they just reported their earnings after hours, so it was somewhat widely anticipated because they're one of the poster children of the emerging marijuana space. And as you can see right here, it closed the session at 111. It is trading down at this point after hours. Now we're only a half an hour after the market closed, so I want to remind you that this can change by the time you're listening to this video or by tomorrow morning. But right now we do see that the stock is down about $3 or so after hours, so not necessarily impressing too many people at this juncture. But anyway, the growth stocks have struggled in relationship to some of the more humdrum consumer staples and utility stocks here recently. In fact, let me take a brief moment to come on over to the internet. First of all, for those of you that do watch these videos on our blog, I would encourage you to give us a heads up that you appreciate the effort that goes into these videos by giving us 3 clicks. You can click like here on Twitter, on our blog. You can click thumbs up right here on your Facebook page, and then you can also click like on our website right there. I want to thank all 120 of my friends that clicked the like button on Twitter the last time I did the video. I really do appreciate that. We generally view 100 likes or more as justification for us to continue to put the time into doing these free videos for you. So if you can get in the habit of clicking like on a daily basis as almost your way to let us know that you want us to continue to do them, we would really appreciate that. But while I'm over here on the internet, I wanted to share with you the sector selector that I put together on Friday. Remember, I put this together each Friday for our members at Market Scholars. And what rotation we saw was, again, more rotation towards the defensive areas of the market. So you have the utilities now back on top after a brief jut down here to the number 2 slot the week before. But as you can see, for the last 6 weeks, utilities have been number 1 for 5 out of those 6 weeks. So they've been a stalwart up there near the top as this market is trying to seek out some safety. We now have the staples as number 2, which is actually their best place, or their best ranking, I should say, over that time period. Remember, the staples have been kind of all over the map this year. This particular graphic here only goes back over the last 3 months, but you'll recall that at the beginning of 2018, nobody wanted to have anything to do with the staples. And now all of a sudden the staples are kind of the talk of the town. And then rounding out the top 3, we do have healthcare, which again kind of has that little bit more of a defensive vibe towards it. And on the bottom side, of this momentum-based ranking system, we have industrials, materials, and energy as number 9, 10, and 11. And again, that makes sense. We saw energy getting pummeled here today. In fact, we were talking about the energy sector in my dividend growth investing trading room. For those of you that are premium market scholars, you're welcome to check that out. That recording is already available for you as we took a look at 2 high-quality dividend-raising companies within the energy patch. But that's certainly been a house of pain from a momentum perspective. So if you're just speculating in the energy area, hopefully you're speculating on the bearish side because it's been pretty ugly with oil here in the last few weeks. So that's where we stand there with the sector selector. Again, the takeaway, this is a market that is still seeking out a more defensive posture. It's seeking out safety. The bottom side of that sector selector, which I don't always share, but I'll do so here today. Generally, this only goes out to our premium members, but it kind of gives you a sense of some of the more extreme stocks out there, whether on the upside or on the downside. Obviously, stocks hitting 52-week highs have some extreme price movements up in many cases, and then the stocks hitting new lows do see the opposite. And one of the things that I wanted to kind of bring to your attention is right here in the staples space, as I mentioned before, you have some of your old steady Eddie standby types and names out there. Stocks like Clorox, stocks like Hormel, stocks like Coca-Cola, stocks like McCormick Spices, and stocks like Walgreens Boots Alliance. Those are not the most exciting names on the planet, but they are the types of names that are working in this type of a marketplace. So keep your eye on them. I know it's not exciting, but right now boring is beautiful. All right, back on track with our chart analysis. I wanted to then take you on over here to our 12 grids to have a little bit of a conversation about that. Let's start with chart 4E. And this will be our intermarket analysis 12 grid. And as this loads up, a reminder that the background colors on these charts will represent whether the entity listed by the chart is either bullish or bearish according to the intermediate term line on the market forecast. And so as we look at this, one thing that was kind of interesting is that the VIX was actually down today. So the VIX was down 2%, despite the fact that the markets were down. Now, the markets weren't down huge, but it is a little bit odd. Usually you'll find that if the markets are down, like we saw, the Dow was down 0.4% today, and the S&P 500 was down 0.15%. Typically, we see a little bit of a boost in the VIX, but we did not get that in this particular case. Some of the other things to be aware of, I thought it was interesting that TNX, which of course measures the yields of the 10-year Treasury itself, fell today pretty substantially, fell 1.29% today. So we ended the day with 3.14% on the 10-year. But equally as important or interesting in my eyes is that just a couple of sessions ago, we had an overbought cluster on the TNX, and we now have closed below that rising moving average. Now, we did have 3 closes below that rising moving average back here as well, and that ultimately formed the bottom before it bumped back up again. But, the wear and tear on a chart, the more time it spends below a moving average, the more possibility that you could actually have a trend change that is taking place there. So, of course, the opposite effect happens down below here with TLT. TLT generally stabilizing here and forming a bottom over the last couple of weeks, whereas you could say the opposite for yields themselves. So again, that kind of reflects that defensive posture where money is trying to drift towards where it perceives safety, and it might actually be forming that bottom in U.S. government bonds where it perceives that safety. And of course, the impact of that is that yields themselves would go lower. Other things of note here today, junk bonds were down today, and junk bonds are actually at 3-month lows. Now remember, junk bonds are oftentimes more associated with crude oil prices than other types of bonds out there. Part of the reason for that is the hot water that a lot of those energy firms got into a few years back. Many of them had to borrow heavily just in order to keep the lights on because oil prices plunged so low. And so you find that the junk bond market right now does have a little bit of a reflection of crude oil prices within it. And of course, as I mentioned before, crude oil has been in a true house of pain for several weeks at this point. Today almost had the had a capitulatory type of effect to it, you'll notice that we've gone down almost every single day for the last 2-3 weeks. As you can see, red candle after red candle after red candle after red candle. Well, today things really spiral out of control. Look at how big that particular candle is down there. In fact, let me right click and go to maximize sell so you guys can see this a little bit better. But if you'll notice this, these are crude oil prices, by the way. So this is the commodity itself. On the Thinkorswim platform, you can pull it up using /CL. But if you count them back, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 straight sessions to the downside for crude oil. I don't care what commodity you are, it's rare to find 12 days in a row of negative prices. And this was the worst out of all 12 of them, as we're down 7% on crude oil today. So that really kind of pulled the rug out from a number of those energy stocks in today's trading. One other thing before we move to our next 12 grid, I just wanted to quickly point out that the US dollar remains very strong. Dollar was weak today, so it was down 0.35, but I just want you to acknowledge that trend right there is very, very strong. And when we get into this strong trending environment with the US dollar, typically that means bad things for the commodities. And you can see how gold has spilled over. You can see how ag commodities have spilled over. And of course, I mentioned crude oil already. Let's take a peek at another 12 grid here. This time, let's go to the foreign stock markets. And as we take a peek at these, there were a couple of maybe surprise movers here today. I would list India and China as being a bit surprising. And again, the reason for that is, on a day when the US dollar is holding up. I shouldn't say it was really strong because it's more the trend of the dollar that's strong as opposed to what happened today alone. But this is generally a time when the foreign stock markets can't hold up quite as well to the U.S. markets. But we actually did find that India was up 2.6% today. In fact, India does have a bullish posture, and it is behaving itself a lot more than some of these other charts. In fact, it's kind of a nice little double bottom there in India a couple of months ago, and we are maintaining strength up at these higher levels right now. So that's a good sign. Doesn't mean we're out of the woods yet on India, but at least it hasn't plunged back down to lower lows. China still has the bearish posture, as you can see with the background color of the chart, but again, we are up 2% today, and perhaps that was what I mentioned in the intro, where they officially put trade talks on their docket. And when I say they, I mean President Trump and President Xi. Now, I think most of us assume that would probably be a key piece of information they would discuss, but they kind of formalized that here today when Larry Kudlow was being interviewed by CNBC. So I guess those two somewhat were impressive today. An area that's really struggled is Mexico. Mexico is down 2% today and hit a new 3-month low. This has been just really, really ugly in Mexico. We're down to 18% in 3 months on Mexico. So that kind of is an area that continues to see a little bit more bearishness. Let's go ahead and take a peek at the U.S. sectors 12 grid now. This will be chart 4G. And so as you look at this, it shouldn't be a surprise seeing the green background colored charts all on the bottom rung. The way I've kind of established this particular 12 grid is to have those more defensive areas of the market on the bottom and the more cyclical areas of the market on the top. So many times they're going to kind of move in unison depending on the theme of the market right now. As I mentioned before, the theme of this market is a market that is seeking out safety where it is finding any success. And so as we take a look at that bottom rung there, it's healthcare, staples, utility, and real estate that are holding up their end of the bargain. And part of that could be what's going on with interest rates as well, to a degree with real estate and utilities. But I think mostly what the dollars are saying when they're flocking to these areas is they want to get away from some of the more cyclical spots like your industrials and your energies and your materials out there. So as you can see, We remain very, very close to 3-month breakouts on both utilities and staples. So if you're looking for bullish price action, that kind of confirms what we just saw a little bit ago on the sector selector. On the flip side, we've got some more bearish areas that we need to be concerned with. Energy, of course, is chief amongst those. Energy is down 2.3% today. Now, this is XLE. That's different than what I showed you before when we were looking at oil prices themselves. These would be the oil companies like your Conocos, your Chevrons, your Exxons, etc. And we're at a key stabilization area here, so we'll see if we can hold the line. But you'll notice that this was the same area that we bounced from here at the end of October. So, you know, if we can manage a rise in oil prices, perhaps there's a reason to think that some energy stocks could be due for a little bit of a bounce here as well. But for the most part, trend-wise, things don't look so hot out there in the more cyclical areas of the market. So that then leads me to our trade application example for the day. And as we come on over here to chart 4A, I just want to remind you that as we look at SPX right here, remember this was the index that today did go to a strongly bearish posture. That's why that background color is dark pink right there to signify that we have strong bearishness at this current juncture. So what I thought we would do is sell a bear call spread on SPY, which is the ETF that tracks the S&P 500. So remember, the SPX is the index itself. SPY is a trading vehicle that many of you can access, whether buying the shares or shorting the shares or doing something in the options world like we're about to here tonight. Now, before we get started, one thing I do want to kind of point out is that we are in a bullish time of year, and it is entirely possible this trade will not work. In fact, you know, for those of you that think we're going to have our Santa Claus rally, this is a trade that could easily go the opposite direction. But then again, this is a market that's been a bit more precarious, and some of you have found yourself way too heavily weighted towards bullishness without hardly any bearishness within your portfolio. Some of you might feel that you want to get some of that balance in your portfolio. So one thing I just want to point out is that it is possible, and we'll just have to see where this goes. But right now, as you look at this pattern, you're probably thinking to yourself, it's setting up to look like an inverted head and shoulders pattern, and that could be true. Now, we don't know because we don't know where this current down move is going to take us. But if we do start getting some stabilization in the S&P 500 around this level and then start popping back up here, and let's say we break out above this double top. So this double top has been formed from basically October 17th and November 7th, those two areas right there. If we bounce from here and go above there, then that would give you an indication that this market wants to be bullish, and it's potentially a signal that you'd want to get out of your bearish trade. So just think of that as you're managing a trade like this or any other bearish trade going forward. But if that doesn't happen, then it might be worthwhile to have an element of bearishness in a portfolio. So the nice thing about the bear call spread is it is a higher probability trade because we will make money off of time decay. So in order to set that up, let's go over here to the trade tab. I'm going to type in ticker symbol SPY, and I've actually got the strikes pulled up down below that I've selected. And I'll tell you that the date that I selected for these were actually the weekly contracts. Now remember, weekly contracts can somewhat be dangerous to implement if there's not a lot of liquidity. Fortunately for this particular trade, SPY is about the most liquid security on planet Earth. So we can actually do weekly contracts on SPY without having too much fear of illiquidity. So these ones, I selected the contracts here that expire on December 14th. And so those are the ones with 31 days until expiration. And you can see that the strike that I've selected here to sell is the 282. The strike that I've selected to buy is the 283, to combine that as a bear call spread. For those of you that are newer to this strategy, what I'm trying to do here is implement a trade that benefits me if there continues to be price pressure on this security. Now remember, this particular security is priced at 272 right now. And if I'm selling the 282 strike, I just need this stock, or in this case this ETF, to not go up more than $10 in the next 31 days. So a number of things can happen. Either the stock can go down, and that would be fine. This is, after all, a bearish posture at the current juncture. It can go sideways, and that would be fine. The stock can even go up $10 per share, and you'd still be fine. But if it starts going up more than $10 per share, then that's biting off more than you can chew. You will start losing money at that point. So if you want to look at where 282 is on the chart and kind of why I selected that particular strike, it's because of this prior double top that got put in right here. Notice that the high price back here on October 17th was $281.15, and the highest price we hit here on November 8th was 281.22. So in other words, if we have a strike that we're selling the 282, you're effectively saying that you believe the market will go up from this level and eclipse these two other points on the chart in the next 31 days. And like I said, seasonality-wise, that's entirely possible. This is not a shoe-in type of a trade by any means, as if there are any shoe-in types of trades out there, but you get the point. You would want to implement this with a little bit of caution, knowing that this is a more bullish time of year traditionally, and this would be used as kind of an offset to your already bullish portfolio that you might have in place. When you get at least 24 cents on a $1 wide credit spread, you are going to have a return of risk of at least 30%, which is typically what we'll shoot for in these videos here. So 26 cents, clearly above 24 cents, so we should be good to go there. So I'm just going to go ahead and click confirm and send. We'll review that one last time, and then we'll see if we can get filled on that first thing in the morning. All right, well, I want to thank you for joining me here tonight. It's always a pleasure to go to work for you. Again, we had a little bit of a pullback today, not a bad one, but it did continue the theme that we saw in the last 48 hours where we switched back to these bearish postures on the market. So this is just a little bit of a digestion time for the market. What we do know is that where there are some pieces of the market that are working, they're oftentimes a little bit more defensive in nature. And so this seems to be a cautionary tone for the market at the current juncture. So with that, I want to wish you all the best with your trades and your investments. Goodbye for now.